individual stocks now. The stock on our radar is Office Space Solutions. The company reported a good set of fourth quarterly numbers. This is the company's first set of earnings post-listing. Amit Ramani, the chairman and MD of the company, is joining us now to take a few questions on the earnings and the outlook going forward as well. Amit, good afternoon. Thank you so much for joining us today. The street definitely likes the profit that you have reported in quarter four. And in terms of losses, they've narrowed in FY24 as well. Is this something that they can expect going forward as well? Profits going ahead? And what is the growth outlook that you have in terms of revenues and margins in FY25?
Sure. So thank you for having me on the program. I think, clearly, turning profitable in the fourth quarter was, a focus area for us. And I think the profitability for FY25 will continue. I wouldn't want to give specific guidance on the numbers, but it will continue. In terms of the revenue growth, we are looking at about 30% growth between FY24 to FY25. And in terms of margin improvement at the EBITDA level, we believe that we can have a margin improvement of about 1.5% from the current 31%.
Okay, so you're expecting FY25 to end, with margins of 1.5% higher. But let's come to, the main part of the business, which is the occupancy rate. FY24 exit occupancy stood at 71%. What has been the trend in Q1 FY25? What has been the new number of seats that you've onboarded? And will that skew the ratio as we head into FY25?
So, occupancy is a build-up scenario, right? Clearly, at the blended level, which is centers gone live, let's say, a few days ago to, from the inception, is at 71%. But if you look at the centers that are 12 months or more of vintage, we stand at 84%. So this has been consistent for the past few years, in fact. And we believe that this level of occupancy, which will be in the range of 70 to 72% at a blended level, and 84 to 85% at 12-month more vintage centers will continue. Last year, we added about 28,000 seats and about 40-odd centers. This year, the plan is to add about 40,000 additional seats. And I say that with a lot of confidence because we exited March 24 at 95,000 seats, right? And we have another 15,000 seats that are under fit-out currently, and another 15,000 odd seats that we have an advanced stage letter of intent. So we believe out of the 40,000 for FY25, we have full visibility currently of about 30,000 out of that 40. So we are very, very confident of our seat capacity growth.
Okay. So, you are talking about occupancies on a blended levels to remain at the similar levels at FY24, but you will be adding a lot more seats in FY25. Would it come at higher rentals as well, Amit? What would the rental picture look like in that case?
So, I think I talked about my model a little bit on the show before as well. So we work about 66% of our portfolio is in partnership with the landlord, where we are either doing a revenue share or a profit share. So that mitigates our risk, where a majority of the new capital comes from our landlord, makes us capital light. And second, the landlord is taking the risk with me. So clearly from that partnership model, we believe that that ratio of about 66 odd percent will continue in FY25. About 35% is what we call straight lease, which is typically in strategic markets and where we already have the demand from the customer. So those obviously are very customer-centric driven decisions, and we will take obviously the right calls. Currently, our portfolio, about 90% is in tier 1, about 10% is in tier 2 cities. But if I look at FY24, in terms of our growth, 85% came from tier 1 and about 15% came from tier 2 cities. So that ratio will continue in that direction.
Understood. Awfis, also give us a sense. Now, 66% is from the managed aggregation model. While, of course, that goes ahead and mitigates risk to a large extent, we also understand that that would also mean slightly lower margins for you against the straight lease model. Could you give us a sense of, what will be the margin differential, and going forward, what do you think is the optimum mix for you?
Yeah. So going forward, the optimum mix will stay in this zone. Because if you look at FY21, we were 46% managed aggregation and the rest was straight lease. Today, we are at about 66%, and going forward, we will maintain the same ratio. We make a bit lower margin when it comes to clearly managed aggregation. Typically, these are between, at the center level, between 22 to 24%, whereas in a straight lease, this would be somewhere around 30%, right? So at a blended level, we are doing at about, at the center level, we are doing a margin of about 25 to 26%. And that will continue because the ratio will continue in the same zone. So the margin as well will continue in the same direction.
So, Amit, when you talk about that 150 basis points improvement in margins, what are you factoring in? What is the reason that will cause that margin improvement?
So one is operating leverage. Our fixed costs or our indirect costs are not going to go linear with our revenue growth, right? So we'll get operating leverage. Second is operating efficiency. Obviously large, and we are now established in almost all cities, and those cities are all obviously generating returns for us. And third is obviously the occupancy itself, right? I think we believe we have some ability to improve that as well. Even though we are adding a lot of additional seats, we believe our sales engine is able to get in front of the occupancy a couple of points higher, and that those three reasons, operating leverage, efficiency, and occupancy, are going to drive that 1.5% improvement.
Amit, give us a sense. Number one, we understand that you'll have two agreements, one with the owner or the landlord, and the other one will be with your client. How often do both of these agreements get revised? Typically, how does it work? What will be the percentage of increase you will see when these agreements are revised? And do you expect this also to be a driver for growth, especially when client revisions come about?
So with our landlords, typically the tenure is 5 to 9 years. And with our customers, the tenure can range from a day to 5 years, right? But today, our blended tenure is about 33 months. Our locked-in tenure with the customer is 24 months. So clearly, from that standpoint, we probably are able to have obviously stability with our landlords for 5 to 9 years. And here we have some clear visibility of demand of almost just shy of 3 years. So from that perspective, in every contract with our customers, in long-term contracts, let's say anywhere between 2 years to 5 years, we have a 4 to 5% escalation built into the contract. When it comes to some of the smaller tenures, we have typically a 6 to 8% built into in terms of our escalation. When it comes to our landlords, we are looking at 15% typically. If it's a straight rental, if there's no minimum guarantee, or if there is minimum guarantee, the escalations don't really kick in. But if there is a straight lease, that increases 15% every 3 years. So which would be average about 4.6% year on year.
Okay. All right. Amit, thank you so much for joining us today and explaining that in detail as well. The street likes the numbers, the stock is high by 4%, and the management is sounding very positive as well. That's the word on office space solutions. We'll slip into a short break. When we come back, we'll be joined by the management of Insecticides India. IMD has revised monsoon forecast for June to below normal from normal. We'll try and understand the demand trends and the sowing patterns as well. Stay tuned.